Welcome to Freight Update. I'm Michael Vincent, and I am joined by my good friend, Mr. Kyle Lintner, Managing Director and Principal at K-Ratio. Kyle, let's start this off before we get to the news and kind of talk about what K-Ratio does and freight futures.
Yeah, sure. First, thanks for having me, Mike. K-Ratio is a risk management firm. What we do is work with shippers, carriers, and 3PLs to first identify the risks that they have, and then come up with tools and strategies on how to mitigate those risks, try and remove that financial volatility from their balance sheet, ideally through the use of something like freight futures.
Yeah, excellent. So we were talking earlier today, a couple times actually, but it's been a year since you and I were traveling around the country, flying on several planes a day, evangelizing freight futures to everybody. So high-level freight futures. What are freight futures so people understand what we're talking about here?
Sure. Very simply, they are a tool much like any other futures contract. This is meant to reduce risk. It's meant for hedging by the commercial end user. So particular to our instance, this is a way for a shipper or a carrier or a 3PL to lock in and fix the rate per mile that they're either going to pay or receive for a truck without actually using or needing the truck, meaning that there is nothing physical to this future. It's purely financial in nature. No truck will bump the dock at any point in any time. We're just fixing the price of that truck for up to 16 months into the future. We trade 7 OD pairs, 3 regional averages, and 1 national average.
Yeah, so solid point, and that point needs to be made again, as we found out as we were evangelizing this across the country. If there's people that are not really familiar with freight futures, no truck's going to show up. This is not a forward contract on capacity that you're buying today for some future amount. It is a purely financially settled hedging instrument to protect you or mitigate the risk against the fluctuations in spot market pricing, dry van, domestic U.S., correct?
Correct, 100%. And I will say the nice cherry on top of all of this, especially for freight, is everything that we do is 100% binding, no failures on commitment.
Oh, excellent. Very good point. Very good point. And so we started out this year and ended last year with some pretty flat, truckload pricing, right? And really nothing in the future that was showing anything that was going to be of any major spike or disruption. And just when everybody is feeling nice and comfortable about where they're at, here we are.
Right. We opened last year, March 29. We saw sporadic activity. We had some big major trades come just prior to peak holiday season on the LA to Dallas lane, which makes sense. That's typically a very volatile thing. Mm-hmm. And then we didn't get it. There was no holiday bump in rates. All of 2019 and the early part of 2020 was very flat, very stagnant. Not a lot to do, not a lot to worry about if you were an end user. And then comes, unfortunately, coronavirus. And since basically March 1st, the wheels have come off the trucks.
Yeah, exactly. And so, I mean, this is isn't this kind of like a really good use case of why you need to pay attention to these type of tools when, even though I don't really need it right now, so I'll worry about it when I do. I don't understand it. I mean, look into it when things are going crazy. But by then, not that it's too late, but it's not quite as effective as it could be had you been paying attention and really learning and utilizing this tool early on, right?
No, that's exactly right. At some point, you've almost missed too much of the move to participate. Luckily for the activity that we saw late yesterday and again this morning, it wasn't there yet. I think we've seen such significant volatility in freight rates that it's almost like a yo-yo going up and down. And right now was an ideal time for 2 different counterparties to come together for a transaction. But if we think about the fallout from coronavirus, this was a piggyback from first Chinese New Year. And then coronavirus hits, so the production stops. We already saw a slowdown. That just continued. We had almost no business coming late February and early March, and then this panic buying. We now have rates that are all over the place on every different lane. Whose guess as to where they're going to lead? And I think that's why we saw the particular product that was traded. If we think it was April U.S. national average, we all know what's going on right now, and that's complete uncertainty. And rates are obviously exploding higher with the volumes. But what are we going to do 2 weeks from now? I'd love to sit here and tell you that I know, but I don't, and I don't think anybody reasonably can. So that's why we use the products that we have.
Yeah, that's a solid point. Is right now you see what's going on, and it's fluctuating like a yo-yo, and this isn't anything we've ever seen really before. It's similar to kind of 9/11, I suppose, but it is completely different as well. And the issue there becomes. how does this rebound, right? Is it a U-shaped rebound? Is it a V-shaped rebound? Does it yo-yo up and down for a while because of this pull forward kind of effect that's going on? And then you have different economies around the country that are on different timelines as to the recovery. So how do those line up, right?
Yeah. It's anyone's guess.
Yeah, it's anyone's guess. So I guess let's. So what's the news on? What's going on? What are you seeing that's going on?
Well, here we just got the news a little over an hour ago that the major U.S. auto manufacturers are going to shut down. So that's just a new kink in this chain.
Right.
You have, it's not dry van usually. We're talking about flatbed, but those drivers can switch equipment and come to something else. So we potentially have even more capacity coming into it. But a couple hours ago, I was on the phone with one of the largest carriers with a brokerage company. I won't name them, but the story that he was telling me there was that they can't wrap their head around what's going on because they were giving quotes to certain customers who said, "Oh my God, I can't believe you guys are giving us this rate. Yes, we'll take it." Turn around, giving the exact same rate on the same lane to another customer who says, "You're twice as much as everybody else. Get lost."
Wow.
So it's like throwing darts at the board here, and it's across all different types of commodities. If you think about it, if you're a CPG, who knows what production is going to be? But if you're a distribution center or a warehouse or maybe the fulfillment for it, you've got extreme demand. But what is that demand going to be in the weeks to come? We all know toilet paper, for whatever reason, chicken is sold out basically everywhere. But does the consumer demand for whatever they deem necessary to get through this, does that change? Does that stay constant? Then how does that work through the supply chain? You know, we've seen the interesting dynamic play out with markets that I won't call them second tier, but they weren't the major market, now becoming preeminent markets to go to. Something like Stockton, California has seen significant increase in volume because that's all warehousing. But then you have something like LA, nobody wants to go there. So the shift in pricing dynamics for lanes can create a ripple effect through the entire supply chain that upsets all of this, which, by the way, we just reset contract rates for a majority of the industry and did it at much lower prices. So now, you can just throw your hands up in the air and pick a price for a lane. Somebody might take it, somebody might not. It's those types of uncertainties and risks that we're trying to alleviate.
Yeah, it's a good point. And so you need like really up to the minute type of data. You've got to be monitoring what's going on in all these markets every day, right? Not only capacity and demand for them, but you got to be watching the economics and the international as well. What are the warehouse inventories doing, right? That is a big shift.
Right. We got a little lucky that inventories to sales have been somewhat high, or at least elevated from, the bare minimum. Usually 1.34 is called the safe part. We're at 1.38 last January.
Right.
So there are supplies inside of the warehouses, thankfully, but now it's getting those all out, and it's getting those trucks in the right place at the right time when that might not be the case. If you think about it, even if you're a shipper and you're not the ones that have some sort of disruption to your production, the servicer that's satisfying your demand might have his previous load canceled. So now he won't have the load that was destined for your location. So cancellation of load A gets you to cancellation of load B, and now those are two loads that need to go out to the market and need to be priced at a new equilibrium, and that's what we're all trying to wrap our heads around.
Yeah, right. So trading in freight futures, these the financial instruments, the hedging instruments, activity good right now? I imagine people are taking advantage of this or trying to utilize it.
We have seen nearly every product across, I'd say 6 or 7 months out at least, be filled with orders. Everyone is trying to put the risk out there and remove it from the balance sheet. I expect that to continue because, unfortunately, I don't think we're going to get any clearer of an idea of what's to come. Everything is right now day by day or even hour by hour. I will say that if we want to take what the market is giving us, we're seeing a modest increase in rates, at least to April. But unfortunately, now May's coming down. June is the month with the big jump. Now it looks like the typical summer demand is now going to push to at least June at the earliest.
Yeah, right. And so I guess people are starting to utilize this right now. They're getting the idea that this is something that they need to be using. I mean, it took this shock for them to go, wait a minute, I've got this tool out here that can help me at least mitigate some of these cost fluctuations, these crazy fluctuations, depending on which side of the coin you're on, right?
Yeah, if we were in class and this was futures hedging 101, this would be that use case that you spoke about. It's almost our real-time living Southwest oil hedge example right now. It's coronavirus came, What are we going to do about it domestically inside of the supply chain? None of us really know, but the way to figure it all out is something like freight futures.
Right. And so you mentioned there's different tools, right? So we have there's 7 lanes, is that right? And then 4 different, I call them baskets. I don't know if that's the correct term.
No, baskets, regions, averages, whatever you want to call them.
Right. So yeah, the different regions or so the 4 different regions. So they have the USA average, the entire US average, with everything boils up into this average price, this contract that you can utilize.
Right. And, that's a very interesting point. So the trades and the majority of the activity we're seeing right now is in that April national average. And I think that makes a lot of sense, not just from the timing. We spoke of that earlier. Nobody knows what's coming 2 weeks from now, but the product. So it was for the national. I know if you could boil it down to what precise lane you would like, that would be the obvious choice. But that's part of the problem that we're all experiencing right now. Nobody knows where that next cancellation is going to come. Nobody knows what their production is going to look like 2 weeks from now. So maybe you can't pick something like LA to Seattle, and you have to say, I just need coverage across the board. Give me blanket coverage, and I'll take the U.S. national. And I think that's going to be the case for the next couple months. We're going to see a lot of activity in the national and in the regional averages because we don't know enough to get that specific inside of those lanes.
Yeah, right. So the national average is the one to go. So I mean, part of the things that you do there at K Ratio is to help people understand those things and where their particular exposure, I guess, correlates to utilize these different instruments. Is that right?
Yeah, that's one of the offerings that we have here because the products that were offered initially with those 7 lanes make a ton of sense. I think it was 23% of all volumes trafficked on those lanes, but up to 80% is influenced by price. What we see more times than not is somebody that is running something like Stockton to Oklahoma City, that's going to pair up with LA to Dallas. And what we do is we take a book of business or the portfolio for the end user and run the correlations and the analysis to find out what fits best inside of the futures product. And then we can make the recommendations of saying, hey, your Madison, Wisconsin to Tallahassee is paired up with Chicago to Atlanta. Feel free to enter into the products. And it's as simple as that.
Right. So I guess, and I'm not quite sure how to phrase this, but so what you're saying, like, if I'm not going to go and correlate and try and find out exactly what basket or what indice, which one of these tools best fits my particular business at this particular moment, the fluctuations, the craziness that we're seeing across the board, a solid instrument to use right now is that national average. Is that right?
Yeah, it's the easiest way to go into it. That touches everyone. That affects us all. That really is the purest measure of capacity versus volume.
Excellent.
For
Excellent.
everyone.
Yeah, understood. So hopefully we get through this soon and we start to see things normalize. We come down on the backside. I hope everybody remains safe out there. Kyle, thank you so much for joining. Everybody out there, peace and love. Stay safe.
Yeah, thanks for having me. Same to you.